Canada is paying more in interest on its debt that it sends to provinces for healthcare. And here's the part almost no one is talking about. By 2028, Canada will be spending more on interest than it does on healthcare and early learning and childcare combined. If you think that won't affect your financial future or the housing market, keep watching. Hi, I'm Marco Momeni, 24 years in Toronto real estate with Remax Hallmark. Every week, I'll break down the big financial stories shaping your future and your buying and selling decisions without the sugarcoating. Today, let's talk about Canada's debt trap, what's really happening, why it matters, and how it ties directly into real estate. Canada isn't just borrowing money, it's borrowing more to pay the interest on the money it already borrowed. Federal debt is now over $1.2 trillion. Interest payments alone are roughly $54 to $60 billion a year. And yes, Canada is paying more in interest than it sends to provinces for healthcare. When debt grows faster than the economy, that's the trap. And every solution hurts someone. People blame inflation, people blame the Bank of Canada or COVID. But the truth goes back further. Canada's debt didn't start exploding because of COVID. The curve bent way before that, right after 2015. In 2015, federal debt was around $612 billion. By 2019, before COVID, it was already past $700 billion. Then 2020 hit, and it shot past $1.1 trillion. And today, we're well above $1.2 trillion. Half of Canada's entire federal debt was added in the last 8 to 9 years. And the spending from that period didn't disappear. It became the new baseline. Then COVID stimulus was added on top of that. Now all of it is being refinanced at today's much higher interest rates. You feel this in 3 ways. First, higher taxes or new taxes, income tax, capital gains, property-related fees. Nothing is off the table. Then spending cuts in areas people care about. Housing programs, municipal funding, infrastructure, and then policy volatility. When governments get cornered financially, they start making unpredictable decisions. And real estate is always one of the first places they turn to because it's the biggest source of wealth in the country. Now let's talk about how all of this actually hits the housing market, because this is where people feel it right away. When government debt gets this high, they start leaning harder on housing. Why? Because real estate is the easiest place for them to pull policy changes quickly. We already see it. They push for more supply, faster approvals, rezoning, density changes, not because the system suddenly got efficient, but because they need the activity and the tax revenue. We see property taxes climbing. Toronto and its new mayor gave us a preview of what's coming. And then we get the reactive policies. The foreign buyers ban, the flipping rules, the vacant tax. We're seeing a mix of push and pull policies. Incentives for builders on one side and new restrictions on investors on the other. And that combination creates uncertainty for regular buyers and sellers. This is why I always tell clients, real estate is not just about mortgage rates or recent sales. It's about policy risk, and policy risk is rising. Unless Canada grows productivity or cuts spending, and right now, neither is happening fast, the debt trap gets tighter. We're likely to see more tax pressure on investors, more incentives and restrictions in the housing markets, more financial stress on municipalities, and more people turning to real estate as a long-term inflation-resistant asset. I'm not here to scare anyone. I'm here to give you clarity. The people who win in uncertain markets are the ones who understand the forces shaping them, not just the headlines. If you're buying or selling the next 12 months, this stuff matters. Not in theory, in the actual numbers of your deal. Stay sharp, make decisions based on real strategy and real experience. Thanks for watching, and as always, ask Marco.